You know that thing where your mom catches you with the devil's lettuce as a teenager, and she confiscates it, gives you the whole speech. This stuff ruins lives. This is for your own good. And then like 3 years later, you come home from college and catch her smoking it in the garage. That is the US financial system in a nutshell. In 2008, the economy crashed. The government bailed out the banks. And every politician, every regulator, every executive in a suit looked into a camera and made a promise. President Obama signing the Wall Street Reform Bill. The American people will never again be asked to foot the bill for Wall Street's mistakes. There will be no more tax-funded bailouts. Period. Hillary Clinton. No bank too big to fail. No individual too powerful to jail. They took the lettuce. They gave us the speech. And now? The same people who were in the room in 2008 era, the ones who either caused the crash, failed to stop it, or got rich cleaning it up, are still driving the car. Except now the car is bigger, it's going faster, and it's been hydroplaning since COVID. I'm not going to explain 2008 to you like you're 5. You've seen The Big Short. You get it. Banks made insane bets on garbage mortgages. Rating agencies called that garbage AA. Regulators looked the other way, and when the music stopped, the whole system almost collapsed. Bear Stearns, gone. Lehman Brothers, largest bankruptcy in U.S. history. Washington Mutual, largest bank failure in U.S. history. AIG, needed $180 billion in government life support. Fannie and Freddie, seized. The Bipartisan Financial Crisis Inquiry Commission, appointed by Congress, concluded that the whole thing was avoidable. Their words, widespread failures in financial regulation, dramatic failures of corporate governance, and a systemic breakdown in accountability and ethics. So what happened to the people responsible? Criminal prosecution? Exposed to poverty? No. Almost nobody went to jail. One guy, a mid-level trader at Credit Suisse. That's it. Lehman CEO Dick Fuld walked away with hundreds of millions. Testified to Congress that he was a victim. AIG's Joe Cassano, the guy whose units bets blew up the entire company, left in early 2008 with a $34 million bonus. DOJ dropped its investigation. Merrill Lynch's CEO, Stanley O'Neill, got forced out after running up massive losses. His punishment? A $161 million exit package. Meanwhile, 8 million Americans lost their jobs. Households lost an estimated $20 trillion in wealth. And by 2009, Goldman Sachs was setting aside $20 billion for staff bonuses. Their CEO, Lloyd Blankfein, said how, and I swear this is real how, that banks were doing God's work. So Congress passed Dodd-Frank, thousands of pages of new rules. Obama stood at the signing ceremony and said, there will be new rules to make clear that no firm is somehow protected because it is too big to fail, so we don't have another AIG. No more bailouts, never again, period. And for about 5 minutes, it looked like maybe they meant it. Here's where it gets uncomfortable. The people who were in the room during 2008, they didn't go away, they didn't get replaced, they got promoted, they moved from Wall Street to Washington and back again, over and over. Let me show you. Timothy Geithner, president of the New York Fed during the crisis, helped engineer the AIG bailout, pushed for TARP, became Treasury Secretary in 2009, where he told Congress, a crisis like this will never happen again. Where is he now? President of Warburg Pincus, a private equity firm, making money in the same financial system he was supposed to reform. Ben Bernanke, Fed chair during the crisis, the guy who in 2007 said subprime problems were likely to be contained. Yeah, he later called that the worst prediction of his career. After leaving the Fed, he became a paid advisor to Citadel, one of the largest hedge funds in the world, and to PIMCO. In 2022, he won a Nobel Prize. Jamie Dimon, CEO of JP Morgan in 2008, still CEO of JP Morgan today. His bank absorbed Bear Stearns and Washington Mutual during the crisis with government help. In 2023, when First Republic Bank failed, guess who regulators called? Jamie Dimon. JP Morgan bought First Republic too. The biggest bank in America just keeps getting bigger. Dimon made $34 million in 2022, and in 2023 he said publicly, we have to assume we'll never let one of these big banks go under. That's not a warning. That's a business model. Lloyd Blankfein, Goldman Sachs CEO through the crisis. His bank got $10 billion in TARP funds and another $12.9 billion through the AIG backdoor. Goldman paid a $550 million SEC fine for misleading investors. Blankfein stayed CEO until 2018. Net worth today, north of $1 billion. No charges. Ever. Janet Yellen, San Francisco Fed president during the crisis, later Fed chair, now Treasury Secretary, the first person to hold both roles. In March 2023, when Silicon Valley Bank collapsed, it was Yellen who invoked the systemic risk exception to guarantee deposits above the $250,000 insurance limit. The stated goal of Dodd-Frank was to make sure taxpayers never had to bail out banks again. 15 years later, the Treasury Secretary is still finding ways to backstop the system. And here's my favorite one, Barney Frank, co-author of Dodd-Frank. The reform law has his name on it. After leaving Congress, he joined the board of Signature Bank. He lobbied to raise the threshold for strict oversight from $50 billion to $250 billion, which exempted banks like Signature Bank. In March 2023, Signature Bank failed. One of the first three dominoes in the banking panic. The guy who wrote the Never Again rules helped weaken them, then sat on the board of a bank that collapsed. You can't write this stuff. So the same people are driving, but here's the thing. The car is completely different now. In 2008, the Fed's balance sheet was under $1 trillion. By 2020, it was $4 trillion. By 2022, it peaked at nearly $9 trillion. In 2008, U.S. national debt was about $10 trillion. Today, it's over $35 trillion. In 2008, the Fed funds rate was over 5%. So when the crisis hit, they could slash rates to zero. That gave them 500 basis points of room to work with. After 2008, rates stayed at zero for 7 years. Then they barely got back up before COVID hit, and they slammed them back to zero again. For 14 years, the longest stretch in American history, we had essentially free money. And then COVID happened, March 2020. Markets are crashing, credit is seizing up, and the government does what it learned to do in 2008 euro, except 10 times bigger. The Fed cuts rates to zero immediately, launches unlimited quantitative easing, starts buying corporate bonds for the first time ever. The balance sheet explodes by $3 trillion in months. Congress passes $5 trillion in stimulus, direct checks, PPP loans, enhanced unemployment. The CARES Act alone was $2.2 trillion OD, almost 3 times the size of the entire 2009 stimulus. And look, it worked. In the short term, it worked. We didn't have a Great Depression. Markets stabilized, people got money. But here's what also happened. The car started going really, really fast. By 2021, inflation was surging. By 2022, it hit 9%, were the highest in 40 years. And the Fed, which had spent 14 years at zero, suddenly had to do the fastest rate hikes since the early 1980s, from 0% to over 5% in about 12 months. That's when the car started hydroplaning. See, hydroplaning is a specific thing. You're driving fast, you hit water, and your tires lose contact with the road. You're still moving. The wheel still turns. But you're not actually in control anymore. The car is floating. And the scariest part? The passengers don't always notice. It feels almost normal, until it doesn't. The driver notices first. They feel it in the wheel, that slight disconnect, that lack of feedback. And what can they do? If they brake hard, the car spins out. If they turn the wheel too fast, same thing. So they just keep going, hoping they hit dry pavement before the curve. That's where we are. The Fed knows. They felt it in 2023 when 3 banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic, the second, third, and fourth largest bank failures in American history, all within 2 months. SVB collapsed in 48 hours. Customers withdrew $42 billion in a single day, the fastest bank run in history. No lines at the branch, just people moving money on their phones while reading Twitter threads about the bank's bond losses. And what did the government do? They guaranteed all the deposits, even the ones above $250,000. They created a new emergency lending program, or the bank term funding program, that let banks borrow against their underwater bonds at full value. The Fed's balance sheet, which they'd been trying to shrink, jumped $400 billion in weeks, 14 years of never again. And at the first sign of real stress, they did it again, because they had to, because the alternative was worse, because the car is going too fast to brake. So what does the driver do when they realize the passengers might be catching on? They turn the music up. The economy is strong. Unemployment is at historic lows. We've achieved a soft landing. The economy has once again surprised us with its strength. That last one is a real quote. And technically, these things aren't lies. Unemployment is low. GDP is growing. The stock market keeps hitting all-time highs. But here's what the music is drowning out. The economy added just 584,000 jobs in 2025. That's an average of 50,000 per month. Sounds fine until you realize that's the smallest annual job gain since 2003 or outside of recessions. The headline says historically healthy. The data says we're barely treading water. Economists have a term for what's happening. Low hire, low fire. Companies aren't laying people off, but they're not hiring either. Everyone's frozen, waiting. Credit card debt just hit $1.23 trillion. The highest ever. Delinquencies are rising, especially among younger borrowers. Nearly half of Americans say they have more credit card debt than savings. 60% of Americans report living paycheck to paycheck. Housing, the median mortgage payment is above $2,500, the highest in history. Affordability is the worst on record. And yet, some 59% of Americans in one survey said they believed the country was already in a recession. Despite the good numbers, there's a term for this too, the vibe session. The economy is technically growing, but it doesn't feel like it, because for most people it isn't. Prices are up 20% since 2021. Wages didn't keep up. Savings got burned through. And now rates are high, debt is expensive, and everyone's stretched. But the music keeps playing. Inflation remains somewhat elevated. The labor market is stabilized. We're well positioned. Meanwhile, commercial real estate is imploding. Office vacancy in San Francisco hit 35%. Major landlords are walking away from properties. Hundreds of billions in commercial mortgages are coming due and can't be refinanced. The yield curve was inverted for the longest stretch in decades, historically one of the most reliable recession predictors there is. Global debt is at $300 trillion, 350% of world GDP, higher than 2008. The 5 biggest U.S. banks hold over 40% of all bank assets, more concentrated than before the crisis. And the tools that fixed 2008, they're already deployed. Rates were at zero. Balance sheet was at $9 trillion. Debt is at $35 trillion. If another 2008 hits, what's left? The driver knows. That's why the music is so loud. But here's the thing about hydroplaning. Eventually, the passengers start to notice. It's not one thing. It's a feeling. That slight float. The sense that the car isn't quite responding the way it should. The disconnect between what you're told and what you feel. You've felt it, haven't you? When they say the economy is strong, but you can't afford a house. When they say inflation is under control, but your groceries cost 30% more than they did 3 years ago. When they say the job market is healthy, but everyone you know is nervous about layoffs. When 3 banks fail in a week and they tell you the system is resilient. The passengers are waking up, slowly, one by one, starting to look at each other, starting to ask questions. And the driver can't admit what's happening. Because if everyone in the car realizes at the same moment that the tires aren't touching the road, the panic itself causes the crash. So they do the only thing they can. They keep their hands steady, they keep their voice calm, and they turn the music up a little louder. The economy has once again surprised us with its strength. The same people who were driving in 2008 are still driving now. They promised it would never happen again. And maybe it won't happen the same way, maybe it won't be mortgages this time, maybe it'll be commercial real estate or private credit, or something in the shadow banks nobody's watching. But here's what I know. The car is bigger. It's going faster. The tools are used up. And we've been hydroplaning for a while now. The question isn't whether we hit the curve. The question is what happens when everyone in the car goes quiet at the same time and starts to feel it.